In this session, let's primarily look at the mechanisms of determination as well as forecasting the exchange rates. So, whenever we talk about an exchange rate in a general scenario, whenever we talk about an exchange rate, we express the value of one currency in terms of the other. So, when I say rupees 61 per USD, so rupees 61 per dollar, wherein my base currency is typically the kind of foreign currency we look at. We generally we generally take the base currency. Let's say I'm an Indian, I'm operating from India, and I am expressing the value of 1 USD in terms of Indian rupees. So, in this case, when I represent an exchange rate something like this, 61 rupees per USD, it means 1 USD, 1 US dollar is going to cost me 61 rupees. And another term wise, USD is called as a base currency for me, whereas Indian currency is called as the price currency, just as a comfort level with respect to the terminology. And when it comes to the exchange rate market, we have a spot market versus a forward market. So, even the exchange rates wise, we see a spot exchange rate versus a forward exchange rate. So, whenever I am thinking of buying or selling currencies immediately, buy or sell currencies immediately in the current at the current market price, I call it as a spot transaction. Generally the currencies are generally the currency processing happens within 2 days of placing the trade in case of spot market. Whereas when we talk about a forward market, the buying or selling of the currencies happen sometime at a future date. Generally, let's say we have something like a 30-day forward rate or a 60-day forward rate or a 90-day forward rate, something like that, wherein the real buying and selling do not happen today, but they happen at a future date, whereas the price setting, the price at which the currency would be bought or sold would be decided today itself. That is a typical forward market, just like any other derivative based market. Now, this kind of exchange currency based market, generally the transactions happen through the dealers. We have foreign exchange currency dealers, and the buying and selling happen through these dealers. The dealers typically have two quotes with them or two rates with them. One is called as a bid rate and the other one is called as an ask rate. And the ask rate is also otherwise called as an offer rate. So, bid rate is always the rate at which the dealer buys the currency from the customer. So, probably if let's say for the same USD, the dealer will have a kind of a bid rate saying 59 and an ask rate, let's say, saying 62 rupees per dollar. It means the dealer is willing to pay 59 rupees to purchase a dollar, whereas if he has to sell the dollar to you, he will be charging you 62 rupees. So basically this difference is what we call as the bid ask spread. 3 rupees in this case is the typical bid ask spread, because this is the prices. Whenever we talk about the bid and the ask prices, they are primarily from the perspective of the dealer, not from the perspective of the individual customers. So bid is the buy price for the dealer and ask is the sell price for the dealer, and the gap between bid and ask is the spread. And the spread again depends on various factors. The way generally the spread is quoted is in terms of 1 by 10,000s. So 1 by 10,000 is actually called as a pip. So the generally the spread is quoted in the form of pip. So basically in this case probably I could have shown it as 3 rupees. So otherwise it would be shown in terms of 30,000, because 1 by 10,000 is typically the pip. So when I say the buy price versus the sell price, so in terms of pip the same 3 rupees would be expressed in the form of 30,000, right? Because we are whenever the difference is, let's say, 0.05 rupees. So if the bid is 59.52 and ask is 59.57, then probably the difference is 0.05, and the 0.05 is expressed in the form of 10,000. So you multiply this by 10,000, so which will give you 500 as 500 pips. So that's a typical way the currency spreads are typically being talked about. And the various things that influence the spread, when I look at factors that are influencing the spread, so primarily it can be classified into the size of the transaction. The larger the size, generally if the buy sell is in very large volumes, the liquidity will become an issue. The liquidity will be much lesser, which in turn will result in spread being higher. So the size of the transaction is one of the important determinants in the spread. Sometimes the relationship that for some clients a favorable rates will be given by the dealers. So client dealer relationship could also be a factor that could influence the spread. But see, the major thing that creates a difference is what is the spread that is prevailing in the interbank market. Because most of the times the dealers maintain their foreign currency inventory by doing the trading in the interbank market. So they generally get into the buy sell transactions, especially by doing appropriate trades in the interbank market. So the spread in the interbank market will determine the spread for the dealers. So the spread, if it is lesser in the interbank market, when can it be lesser? Especially if the currencies are if the currencies are more and more liquid, right? So high volume kind of trading happening on some currency pairs, there the spreads will be lesser. But for those pairs where the volumes are less, there the spread will be higher, because it's again associated with the liquidity itself. But much more than that, what is understood is, especially when both the currency markets, the New York currency market as well as London currency market, both these currency markets, when both of them are open, the time frame during which both of them are open, it is expected that the liquidity is very high during that period, which will again result in the spreads going lower during that particular period. And also the volatility of the existing markets, exchange rate fluctuations, the volatility of exchange rate. If the volatility is, if the exchange rate is fluctuating drastically, for that particular exchange rate, we see that the spread will be higher. But whichever exchange rate is more and more stable, probably the spreads of the dealers also will be stable in this regard. So, before we get into the calculations aspect, understanding the basic transaction of the forex market is really required. And typically, when we are talking about forward markets, the spreads are more higher and higher based on the maturity. If the maturity period is very long, we see that the spread will be much higher because liquidity will be an issue. Similarly, counterparty credit risk will be much higher in case of long term contracts. So the counterparty credit risk also, because it is higher, obviously long term forward contracts will have a bigger problem. And similarly, the interest rate risk also will be a bigger problem because the interest rates can fluctuate quite drastically during this period. So because of all these reasons, what we see is the forward rates in a long term maturity contracts are much more higher compared to the forward rates for a short term maturity contract. So the basic structure of the currency markets is something which we need to understand before getting into the calculations involving the foreign exchange currency, including the foreign currency. Alright. So when there is a typical quote which is saying rupees 59.23 to rupees 59.75. So what it means, from a dealer's perspective, the dealer would be buying a dollar. This is, let's say, the rupee to dollar kind of a exchange rate. So the dealer will buy at 59.23, which means if I look at it from an investor standpoint, investor has to sell $1 to the dealer at 59.23, and investor can buy $1 at 59.75. So basically, if the investor is interested in buying the base currency, right? If the investor is interested in buying the base currency is always like, for 1 unit of base currency, what is the price currency? That currency is what we call as a base currency. So if the investor is interested in the base currency, the buying, he should always buy at the ask rate, whereas the selling, he will be doing at the bid rate. And the same logic, let's say if he is going for a price currency. So look at it like this. He wants to buy rupee. If I want to buy rupee, right, the investor has, let's say from an investor standpoint, he wants to buy rupee. So if he is wanting to buy rupee, he has to sell dollar. Selling the dollar happens at the bid rate. Selling the base currency happens at the bid rate. So buying the price currency happens at the bid rate, and selling the price currency happens at the ask rate. So this relationship also we need to be comfortable with, depending on whether the person is, depending on the quote that is available, am I buying the base currency or the price currency? If I am buying the base currency, it should be at the ask rate. But if I am buying the price currency, it should be at a bid rate. And entirely opposite exists if I am selling the base currency or selling the price currency. So whenever any kind of situation comes, let's say I have an exchange rate. Now if I want to look at a quick numerical in this case, let's say I have an exchange rate saying rupees 59.23 to rupees 59.75, and this is for rupee, Indian rupee to US dollar kind of a transaction. Now let's say I have $1,000. I have $1,000 with me. So how do I look at this $1,000? Let's say I have $1,000 versus 1,000 rupees. How I could have converted them? If I'm having $1,000, I am selling the dollar. Let's say I'm an Indian. I want rupees, and the quotation is in the form of rupees per dollar. So dollar is the base currency. So I am selling $1,000. The selling has to happen at the bid rate, right? The selling has to happen at the bid rate. So $1 is 59.23 rupees. So $1,000 I would be able to sell it at 59,230 rupees. That is when I am looking at the bid. But when I am having 1,000 rupees and I want to sell off the 1,000 rupees, but the quote is in the form of rupees per dollar. So what I am selling is the base is not the base currency, it's the price currency. So when I am selling the price currency, it is like I am buying the base currency. Investor is buying the base currency, the dealer is selling the base currency. So the dealer is selling the base currency at this particular price. So he will sell $1 at 59.75. So if he is selling $1, you are buying $1. So by selling 1,000 rupees, whichever you have, you are buying 1,000 divided by $59.75. So you have to use the ask rate there. So that kind of a comfort level should typically come up as an investor just by looking at this particular quote. How do I make out how much I would be receiving or how much I would be paying, depending on what is the quote, which is the base price, and which is the base currency versus the price currency, and based on that I would be getting into a transaction. Here sometimes the next thing which I would like to look at is the cross currency rate, especially if I am involving a third currency also, right? Especially when I am involving a third currency, like okay, I am having 59.23 or 59.75 is one of the dealer, rupee to dollar, rupee per dollar, and on the same way, let's say I have dollar to euro, $1.5 to 1.55, the dollar to euro. Now when I am looking at cross currency, basically once there is a rupee to dollar, and I have dollar to euro. So when I am multiplying these two, the dollar is getting cancelled off and it is coming out as rupee to euro kind of a mechanism. So whenever I have such kind of cross currency scenarios, so if I want the base, if I want rupee to euro, both in the rupee per euro, I can take both in the bid form as well as ask form. So rupee to euro, as far as the bid is concerned, it is 59.23 into 1.5, and rupee to euro, as far as ask is concerned, it is 59.75 multiplied by 1.55. Right? So, okay, let me see what it is. 59.23. So otherwise, rupee to dollar. Rupee to dollar, the bid is 59.23 rupees to dollar, whereas the ask is 59.75 rupees per dollar. Similarly, when I am doing dollar per euro, it is, let's say I am taking 1.5 as a part of the bid, which means 1 euro is costing me $1.5, and similarly 1.55. So from a dealer's perspective, the dealer is willing to buy euro for $1.5, and he is willing to sell euro at $1.55. So that $0.05 is the spread which he would be typically looking at. Now what we are saying is, if I want rupee to euro, this is what we call as a cross currency rate, wherein I am using these two currencies, rupee per dollar, dollar per euro, multiply these two things to arrive at saying, okay, rupee per euro, the bid rate is 88.84 and the ask rate is 92.61. So if at all I have to buy as an investor now, if I want to buy 1 euro, right, from a dealer point, he is selling a euro. So he has to sell it at 92.61, whereas if at all I am planning to sell euro, the dealer should be willing to buy at 88.84. This is how we arrive at the cross currency rate, both for a bid as well as ask kind of a transaction. Now, the next thing which I should look at in this context is the concept of triangular arbitrage. What it means is, let's say now when I looked at these two markets, these are the two quotes which the dealer has given, and based on this I am able to derive that the rupee to euro is something like 88.84 to 92.65. But when I asked my dealer about the rupee to euro quote, the rupee to euro quote, probably let's say he is saying the bid is 88 and the ask is 93. Let's say when I have asked my dealer about the quote, or probably 91. When I asked the dealer about the quote, he has given me 88 and let's say 91. These are the bid and ask rates which he has given. Whereas when I am doing this kind of an exercise, I am getting 88.84 for bid and 92.61 for ask. So both of them are for rupee to euro itself. So because these two prices are slightly different, what I am getting by a triangular, by converting rupee to dollar along with dollar to euro, or rupee to euro directly, based on these two different kinds of transactions, I am getting two different bid and ask prices. So I want to look at this particular possibility, and based on that try to work out with the possible arbitrage. right? I would like to look at these particular numbers and then possibly try to work out with the possible arbitrage. And wherever the bid, see, let's say if I want the reverse, so if I want, let's say in any case, euro per dollar kind of thing, if the dollar to euro is given and if I want the euro per dollar, let me just give you, in case some necessity comes at some point. If I want euro per dollar, for the bid I will take 1 by the ask of dollar to euro, and even I will take 1 by the bid of dollar to euro to get euro to dollar. This is one more thing that we just need to be aware of, though in this scenario I don't require that, but just to be aware of, I am giving you an understanding on that dimension. Now that we have something like this, what we see is the bid and the ask, both of them, the bid and the ask, both of them, we see that whatever your dealer has quoted are lesser than what our numbers are coming out to. Now this is where I'll start building a kind of an arbitrage transaction. Right, this is where I'll start looking at building a arbitrage transaction through this triangular opportunity. So what is the triangular opportunity I am looking at? Okay, let me create a triangular scenario. I have three currencies here: the rupee, the dollar, and the euro. Okay, so the rupee to dollar, I have one relationship: $1 equal to 59.75 rupees. So when I am converting my rupee as an investor, now I'll see, if I am converting my rupees into dollar, I have to get it converted at the rate of 59.75, because here the quoted rate is rupee to dollar. So I want to sell off my rupees. So price currency is what I want to sell. So I will sell the price currency at the ask rate. Similarly, if I want to sell dollar to euro, if I want to sell dollar to euro, we said it is 1.55. So selling rupee to converting rupee to dollar at 559.75, the dollar getting converted into euro at 1.55. So which means converting euro to rupee is, from the market standpoint, so it is 59.75 times 1.55. So the same way I can look at converting the other way, even from a bid perspective. If these are bought and this is sold, even this way another transaction is getting created. Now let's see the transaction. I have a bid at 88 I have computed the bid at 88.84. So as an investor, I could sell. I could from a dealer's perspective, he is ready to buy euro at 88 rupees. So if I go with this route, I would be selling euro at 88 rupees. Whereas if I go with this route, I can sell €1 at 88.84 rupees. This is what is the difference. So let's say I have 1000 euros with me. Right now let's deal with this transaction. If I am having 1000 euros with me, if I directly deal with the dealer quote, what could very well happen is he is ready to buy euro at 88. So what I would be getting if I sell the euros, 1000 euros, I would be getting only 88,000. Rather than that, what I can do is the euros first I can get converted into dollar. So I'll ask the person to give me dollars for the euros. So he will be giving me $1,500. Then I will sell the dollars in exchange for rupees. So he would be buying dollars in exchange for rupees at 59.23. So into 59.23 if I am doing, I am actually getting 88,845 in the process. So I am able to get another 845 extra if I am doing this kind of cross arbitrage kind of a transaction rather than directly selling it at 88 itself. So that way I can make some kind of arbitrage profit in these kind of transactions. Whatever is the money I am having, even with the local money whatever I am having, let's say if I have rupees, I want to convert them into euros. Another scenario. Let's say I have 10,000 rupees with me and I want to convert them into euros. So I have to sell rupee and buy euro. If I have to buy euros, the dealer will be selling the euros at 91. Right? The dealer will be selling the euros at 91. So I will directly, now let's look at this triangular transaction. I will directly, let's say I am starting with 10,000 bucks. I will sell the 10,000 rupees directly to my dealer. He is willing to sell euros to me at 91. So because of this, whatever the 10,000 rupees I have, using that 10,000 rupees, I am able to convert them into 109 euros. Now this 109 euros, I could sell them. If I sell them directly, the dealer will be buying, right, 109 euros. If I am directly selling it and converting them into rupees, the dealer would buy the euros, whatever these are the number of euros I had. The dealer would buy them and he would give me only 9,670. I am losing in that process. Rather than that, now if I have these many euros, I will get them converted into dollars. So corresponding to these number of euros, I will get these many dollars. And after that, I will convert these dollars into rupees by multiplying it by 59.23. So in this case, I would be ending up with 9,763, whereas here I am ending up only with 9,670. So I can create, especially in cases where this gap is slightly much more better, I can create a quick profit because of these kind of transactions straightforward. Right? In this case, I could have gone the other way. Right? But especially when these kind of opportunities are existing, I can do the quick conversions to various currencies, and based on that I could generate a kind of arbitrage profit in these transactions also. So that is what we meant to say by using a cross currency arbitrage or using a cross currency arbitrage to get a gain. We see directly if I sell it Probably I'm getting only 9,670, but by doing this 9,763, and if these gaps are much smaller, if the spreads are much smaller, there is a good way to make a big business by transacting in this kind of a model, right? So that is how we look at the cross currency rate and look at triangular arbitrage kind of a mechanism to profit from the foreign currency differences in three different currencies. Using three or more currencies, we can create this kind of cross currency kind of arbitrage opportunities. The next aspect that we need to look at is how do we look at this bid and ask prices in the forward market. So in the forward market, which we typically if we typically look at the bid and ask kind of prices, we see that they are quoted generally at a forward premium or discount. So if I say the spot rupee to dollar rate is 59.23 to 59.75, what I am saying is in the forward it may be quoted as, let's say, a 30-day forward. It may be quoted as plus 0.23 to plus 0.27. So what I should interpret this as is, in the forward market, a 30-day forward quote for this is nothing but 59.46 is the bid rate and 60.02 will be the ask rate for the dollar if at all I am trying to buy it after 30 days. Right? After 30 days, my buy or sell quote or my buy or sell transactions with respect to the dollar will be, as an investor, I would be able to sell dollar at 59.46 and buy dollar at 60.02. So this is how typically we see the forward market quotations. Wherever we are seeing that in the future, if the base currency is going to be priced higher, we say that it is being sold at a premium. So this premium and discount are the words, especially with respect to the base currency. If the base currency is going to cost lesser with respect to the price currency, then we say that it is going at a discount. So probably here because of the premium, we are saying that $1 will be available at 59.46 rupees from a buying standpoint. So the dealer is willing to buy dollars from us at 59.46 rupees and he is willing to sell dollars to the investors at 60.02 rupees at the end of 30 days. So that is what is the typical spot and forward quotation. And based on this, if I want to find out what is the value, right? What is the value if I am getting into, let's say, if this is the kind of a transaction that is available today, let's say I want to buy, let's say after 30 days, I want to buy $1,000. So today I don't want to buy. If I want to buy $1,000 today, probably I could have paid 59.75 rupees per dollar and I could have bought the dollar. But I don't want it today. I want to buy it after 30 days. So I want to buy $1,000 after the 30-day period. So based on this, now I would like to see at what rate. So if at all I am going for a forward contract, I could have bought dollar at 60.02 by fixing the price today by entering into a forward contract. I know I will be able to buy dollar at 60.02, so which means I require 6,020 rupees to purchase $1,000 after 1 month. But assume that after 1 month, the contract rate, right, the contract rates, the spot rates have gone up. Assume that after 1 month the spot rates have gone up to 60.5 to 60.75. Let's say after 1 month, in reality the spot rates have gone up. Then probably if I had to buy it at this point, then it would have costed me very heavily. And on the other side, now that I am able to buy $1,000 by spending 60,020 and I have $1,000 with me, I can very well sell off those $1,000 and the dealer is willing in the spot market where the dealer is willing to spend 60.5 for the $1,000. So directly my amount is becoming 60,500, because of which I am able to gain 480 rupees in this transaction because of the difference in the difference between the spot and the forward market. Especially on the maturity date, if I want to check out the gain or the loss, I can look at whatever the contract rate at which I am either getting into a buy or a sell, and then once I have possessed that, immediately doing the reverse in the spot market might give me a profit or a loss situation in the overall scenario. So in some cases I can make a profit depending on the amount I am working out with, and in some cases it may very well result into a loss. So rather than remembering any kind of big formulas in this aspect, if we can try to understand it more from a logical standpoint, it becomes very easy to understand these kind of spot and forward markets and the price and the profit and loss that come out of these transactions. So the next thing which we need to look at in this context is how would these transactions be handled in the forward market. In general, in the forward market, we see two terms, a premium and a discount. So if the base currency is sold, or if the base currency is going to increase in the future corresponding to the spot, if the base currency in the future is going to be greater than the spot, we say it is going to be traded at a premium in the forward market. And if the base currency is going to be available at a lesser rate, then we say it is available at a discount. And generally the premium or the discount is the difference between the forward currency forward rate and the spot rate. And the way it is generally quoted, let's say right now for USD versus euro, or USD versus AUD kind of transaction, or USD versus euro kind of a transaction, Right here, euro is the base currency, USD is the price currency. So now let's say in the spot market, I see that USD to euro is, let's say the quote is 1.152 and dollar 1.1536. Let's say this is the quote in the spot market, and I am looking at, let's say, a 30-day forward market where I am quoting it as plus 25 plus 28, which means if I so in the forward market the euro will be traded at a premium. So plus 25 is nothing but what would have been the 30-day forward price. Going with this logic, the 30-day forward price should have been 1.1520 plus 25 by 10,000 because it is quoted in the form of pip. So it should be plus 25 by 10,000, so which should have been 1.1545. Similarly, this should have been 1.1664. This should have been the forward prices. Now let's say I have got into a forward contract, a 30-day forward contract, and because I have got into a 30-day forward contract and thinking of I want to buy 1000 euro, right? I am a US investor, I want to buy 1000 euros after 30 days. So because of the forward contract, I would be able to buy euro at the rate of 1.1564. So 1000 euros means I may have to spend $1,156.4 to buy 1000 euros. But let me imagine that 30 days have already passed, and after the 30 days I am seeing that the quotes are 1.156 or 1.157 and 1.162. Let's say these are the spot prices on that 30th day. So now that I have $1,156 with me, I can very well convert them into euros because this is USD to euro. I can sell off the dollars, buy euro. If I have to buy euro, the dealer will be selling the euro. Dealer will be selling the euro. See, I have dollars with me. I bought 1000 euros by spending $1156. So I have 1000 euros with me. Right, I have spent $1156. I got 1000 euros with me. So now I want to sell off the euros and buy dollar. Sell off euros, the dealer has to buy euro. He will buy at this particular price. So immediately with 1000 euros, 1157. So I am getting $1157 because of this transaction. I started with $1,156, converted them into euros, and by entering into the forward market. But I am seeing that I can very well sell off the euros in the spot market on that day and make some kind of a profit. So this is how we find out the value. So whenever we are talking about a value, we are especially at the maturity, we are thinking of based on whatever the transaction we have gotten, whatever the money we were, whatever the currency we were able to purchase. Immediately when I am able to sell it off in the spot market, what is the kind of profit that is coming up? That is what is the typical way I look at the value of the contract. The same logic goes, especially if I want to evaluate not on the expiry date but before the expiry itself. Let's say 15 days after the contract, right? This is a 30-day contract, but 15 days after the contract I would like to look at what could be my benefit on that particular date. So for that, all I am looking at is what is the deal price. The deal price which I have entered in is 1.1564, right? That is the deal price that I have entered in. 1.1564 is the rate of dollar that I have fixed at. So somewhere in the middle I want to check out what is going to be the profit or loss for that position. Now in the middle, if I am looking at, let's say, 15 days, I require the details for the after 15 days what are the scenarios. Let's say the spot price after 15 days is 1.156 and 1.1565, and a 30 and a 15-day forward is available, let's say, at +3/+5. So which means the 15-day forward is actually available at the 15-day forward, the prices are 1.1563 and 1.157. Now if at all I had to sell it off on this day itself, so I would have got the dollars, I would have been able to sell the euro, 1000 euros at 1.1563. So 1.1563 minus whatever is my contracted price, 1.1564, multiplied by whatever is my contract size, because I would have bought it at 1.1564, but I could have bought the euros at 1.1564 a dollar by getting into the forward market, but now the sell price per my dollar is only 1.1563. Sell price per the euro is $1.1563. So I would generally incur a loss of $0.0001 for every dollar that I have invested. So I'll multiply it by the contract size. So basically, if I am looking at my contract size is 1000 euros. So this is the amount of loss that I am going to get. But this loss is after 15 more days on the 30th day. So whatever is this loss, 0.0001 into 1000. So the loss is going to be minus 0.1. This loss is going to come up after 15 days. So I have to discount it by the R in the base currency, the R in the price currency into 15 by 360. I discount this and find out the present value of this particular profit, and I'll say that this is the value of the forward contract prior to the expiry date. So if I am more interested in finding out what is the value, what is the benefit of getting into this forward contract, what is the value that is associated with this forward contract, I can look at it on the date of expiration as well as much before the date of expiration also. So when I am looking at it much before the date of expiration, this is how we typically look at it. So just taking a quick example where we can work out much more better. I take one quick example for us just as a quick summary. So let's say I am talking about getting into a contract on 1st Jan 14. I am looking at a 90-day forward contract. What is that 90-day forward contract? To buy $1,000 against Indian rupees. I am spending Indian rupees. Let me write by using Indian rupees INR. And today the rates are like this. The spot rates. So the day on which, let's say, I am entered into a forward contract, a 90-day forward contract, I have entered it at INR 60.23 per USD. I want to buy 1000 USD, right? And the day on which I have entered into a forward contract, let's say it is available at 60.23 INR per USD. So if at all I am going to stick with the contract, obviously I have to spend 60,230 INR on 31st March 14. And by paying 60,230 INR, I would be getting $1,000. And in this, let's say the bid and the ask prices are 60 and 60.23. So 60.23, because I want to buy dollar and the quotation is rupee per dollar. Dollar is the base currency. So if at all I have to buy, the dealer will sell it at 60.23. So I am spending 60,230 bucks to purchase $1,000. Now I want to establish the value. I want to establish the value. Two different types of values I am looking at. On 31st March, which is the expiration of the forward contract, if at all I know that the spot rates on that day are 60.3 by 60.5, what we are saying is, yes, I am having $1,000 with me because I have spent 60,230 rupees for that. Now that I have $1,000, I can sell off those $1,000 at 60.3. So all I am going to get is 60,300, which means a profit of 70. So the way I can express it is, on the expiry date, whatever is the spot price, the bid rate of that spot price. So the bid rate of the spot minus the ask rate on the day of entry into the forward contract. On the day of entered into the forward contract, whatever as the ask, that difference multiplied by whatever is the whatever is the base currency we are talking of, that is the contract size, that would be the profit or loss. So 60.3 minus 60.23 multiplied by 1000, which is 70 rupees, is the profit in this particular transaction. Now let's say I want to look at the value on 31st Jan 14, which means there are 60 more days for the expiry of the contract. So for this, what I will look at is, again I will see the quotations. Let's say on that 31st Jan, I have seen the quotations as 60.15/60.4, and when I am looking at the 60-day forward, because 60 more days are available, when I am looking at a 60-day forward, let's say it is available at plus 300 plus 200. It means actually 300 by 10,000. So basically it is available at 60.18/60.42. which means if at all I had to buy as per this forward contract, I would have sold my dollars, whatever the $1,000 I am having, I am forced to sell them at 60.18 only. So, which means at that point, as on 31st Jan, if I want to know what is my value, I'll take 60.18, which is coming out based on the spot on that day and a 60-day forward, minus whatever is my contracted rate, multiplied by the size of the base currency. This is the profit or loss that is going to come on 31st March 2014. So if I want to know what is the equivalent profit or loss on 31st Jan, all I should do is I should discount it based on the price currency. Let's say 8% is the interest rate in the price currency, which is in Indian rupees. In India, if the R is around, risk free rate of return is around 8%, 60 more days to maturity, I discount it by this. That is what is the value of this forward contract on the currency as on 31st Jan 2014. This numerical should give you a clear cut amount of idea in terms of how we can talk about the profit or loss, or how we can evaluate the value in a forward currency contract kind of a transaction. Now let's look at the next important topic, wherein we are looking at the various international parity relations. So to start with, we are getting into the covered interest rate arbitrage. What is this covered interest rate arbitrage? Especially when we use the forward rate, whenever we see that the forward rate exists and the premiums or discounts which are there on the forward rates, they are used to offset any kind of differences that are coming up in the interest rate. So whatever is the I1 minus I2, whatever is the interest rate differences that is existing, that is getting reflected in the forward rate. So whatever is the premium or the discount which the forward rate is typically operated at, that is purely based on the interest rate differentials in the two countries. So that kind of mechanism is what we are calling as covered. Whereas if it is not covered, means there is no forward rate kind of thing existing, and whenever we use the word as expected spot rate in the case of forward rate, we talk about the uncovered interest rate parity. So, probably when we are talking about a covered interest rate, I'm talking about in country 1, if the interest rates are higher than the country 2, then the depreciation in the currency 1 with respect to currency 2 will be simply offsetted by this relationship itself. So that's the reason we say in case of covered interest rate arbitrage, we try to say that we try to check out with this kind of an equation. Is the forward rate is equal to the spot rate S naught into 1 plus the forward rate, interest rate when we are talking about the forward rate, we are looking out for the spot rate S naught, and we are looking for a currency A versus the currency B. So, which is nothing but per 1 unit of foreign currency B, what is the kind of a domestic currency? If I am looking at domestic versus the foreign kind of a situation. So, whenever we are talking about, let's say, 60 INR per dollar. 60 should be in the numerator, the INR should be the interest rate of India should be in the numerator, and United States should be in the denominator. That's the kind of a convention which we need to follow for the same. So that's one thing we need to be comfortable with, and so otherwise, if at all that relationship is not holding true, then probably I'm looking at some kind of arbitrage opportunity in the process. Straightforward. If an arbitrage opportunity is existing, then I can borrow in one currency, probably invest in the other currency, and again pay back in the other currency, and finally make a profit in the process. So let's see, I'll take one example to cover the same. Look at this example here, then I'll come back. An investor living in Japan. So Japan is the domestic currency. The Japanese yen is the domestic currency, so he can borrow either in its domestic currency or in the foreign currency. So now, so from there we are looking at, is there any kind of an arbitrage opportunity existing? So this is where I can see that this is the spot rate, exchange rate, this is the forward. So according to our no arbitrage relationship, actually the forward rate should be equal to the spot rate into 1 plus the domestic, the interest rate in the domestic currency, which is Japanese currency, divided by 1 plus the interest rate in the foreign currency, which is the US currency. So probably I am simply checking out the spot rate 116.35 into 1 plus the domestic currency 1.015 divided by 1.04. So probably I am looking out for the calculation 116. I am doing out a calculation 116.35 into 1.015 divided by 1.04. This is giving me 113.55. This should be the forward rate if there is no arbitrage opportunity. But the actual forward rate is only this much. So the forward rate is actually less than the theoretical forward which we are determining. So the simple thing is, probably now I can borrow. Now if that is the case, I could very well borrow in dollars, borrow in foreign currency. Whenever I am seeing that the forward rate which we see in the market is less than the forward rate which we get from the theoretical scenario, then we can say these are the steps. Borrow in foreign currency, then invest in domestic. Invest in domestic. So you get something after the investment, right? Then pay back in the foreign currency. Corresponding to your amount, you identify. So let's say in this example, if my domestic amount was 58,175,000 Japanese yen. So what does it work out in dollars? 58,175, 58,175,000. I am converting it into dollars 116.35. This is equal to $500,000. So I will borrow $500,000. Right? I will borrow $500,000, which means at the end of whatever is the period, I am paying a 4% interest on it, which means for that loan I have to pay back $520,000 in total. Fair enough. Now what I'll do is whatever the 58,175,000 N which is obtained by borrowing this much and converting it into Japanese currency. If I invest this amount, I get 1.5% excess on the top of it. So basically, at the end of the period, my amount becomes 58,175,000. I'm investing at 1.015 return. So this much is my amount at the end of the period. But now, at the end of the period, if I had entered into a forward rate, if I had entered into a forward rate agreement in the beginning itself, or now the forward rate is 112.99. So if I am converting this into dollars, actually this is becoming 522,000 $591, which means almost $2,591 is the benefit that I have got in this transaction. Or probably we could have converted it into N at the rate of 112.99 and say this much of N is the profit in this particular transaction because of this arbitrage opportunity. So that's how we can evaluate the arbitrage opportunities under the covered interest rate arbitrage model. Whereas when I am using the word uncovered, right? So it is basically it's not bound by any form of arbitrage, because as we have discussed in the covered, the arbitrage is forcing the forward exchange rate, whatever the forward rate, to come in line with the interest rate differentials between the two countries. Suppose there was no forward market at all we are talking of is the expected spot rate. We cannot use a forward market because forward market is not existing, or the forward market is not that liquid in that particular country. Then probably using the forward rate is not appropriate in the situation. So that's the reason I cannot go with a forward rate, but I can talk about an expected spot rate. And whenever we are using the word expected spot rate, here also we are using whatever is the interest rate in the domestic currency divided by the interest rate in the foreign currency. This should be reflected in the expected spot rate. So whatever is my base currency, it can appreciate by the difference in the interest rate levels. The base currency, which is the foreign currency, that can appreciate by that much of a difference. So if the difference is positive, the base currency appreciates, otherwise it depreciates. So again, as I said, depending on which one is the first, we will typically take that into the numerator, the other one is taken into the denominator. So that's one more thing we need to be comfortable with. So whenever we are using the covered, we are talking about the no arbitrage forward, whereas whenever we talk about the uncovered, we talk about the expected spot. Obviously, both of them should be equal, right? In case of we see the forward market existing, to a large extent we see that the forward rate will be equal to the expected spot rate in the future itself. So which means we could generally see that the forward rate is more or less determined as a mechanism of expected spot rate itself when there is an active market for it. But when there is no active market, probably there could be a huge difference between these two kind of stuff. That's one more thing we need to be comfortable with. Then when we are talking about the next important, which is the international Fisher relation, Earlier we used this example, simply speaking, when we were talking completely in the domestic terms, or we generally know this kind of a relationship that the nominal rate of interest is equal to the real rate of interest plus the expected inflation. This is one regular relation we keep talking about, or probably in a very precise form if I want, I talk about 1 plus nominal rate of interest is equal to 1 plus real rate of interest into 1 plus expected inflation in the future. This is the typical relation which we know as a relationship between the nominal rate and the real rate. But here, when we talk about the international Fisher relation, we are primarily looking at the relationship between two countries. So the same logic I could have used between the two countries. So which means probably I call it as RN1, RR1, EI1. And I could have simply said the nominal rate in country 2 is equal to the real rate in country 2 multiplied by 1 plus expected inflation in country 2. And probably if I divide it across, I could say 1 plus nominal rate in country 1 divided by 1 plus nominal rate in country 2, under the assumption that the real rate in both the countries is more or less the same. We could very well say that this is working out as 1 plus expected inflation in the country 1 divided by 1 plus expected inflation in the country 2. Or probably again going on a similar terms as this equation, I could say that the nominal interest rate of country 1 minus nominal interest rate of country 2 should be equal to the inflation expected in country 1 minus the inflation expected in country 2. So probably that is one more thing we are talking about. The major relationship we are talking about is the difference in the nominal rates of two countries is equal to the inflation differentials between the two countries, under the assumption that the real rate of growth in both the countries is more or less the same. Otherwise, I may have to consider even those things as a part of my relationship. Then the next thing we are talking about is on the purchasing power parity, which says the exchange rate, the differences in the exchange rate, it definitely has to reflect the differences in the price or the inflation between the countries. As straightforward as that, right? Because whenever we talk about comparison of the average price on some kind of a representative set of goods in both the countries, under the assumption of or under the law of one price, which is typically the governing factor for the purchasing power parity, whatever is the basket of goods in one country, when I compare it with the similar kind of a basket in another country, then whatever is the difference or whatever is the ratio, that should be the exchange rate of that particular between the two currencies itself. So whenever we are talking about the relative purchasing power concept, I could very well use this kind of a relation: ST equal to S0 into 1 plus inflation of country A divided by 1 plus inflation of the country B, which is nothing but whatever is the expected spot rate in the future. I can simply take it as the current spot rate, spot exchange rate, multiplied by 1 plus inflation in the country A divided by 1 plus inflation in the country B. And that is what has been mentioned even as a part of our interest rate parity kind of a relationship, where whatever the changes in the exchange rate that is coming, it should be reflected in such a way that the risk adjusted returns in any currency will be equal itself, right? We generally use the X and T we generally use the ex ante version of the purchasing power parity, which is nothing but the relative purchasing power parity using the expected inflation rather than the actual inflation. When I am using the actual inflation, we are getting the real purchasing power parity, and when I am using expected inflation, I can call it as ex ante purchasing power parity relationship. So primarily when I am looking at the various kinds of mechanisms, any kind of exchange rate movements, the change in the exchange rates is based on interest rate differentials, reflecting in the exchange rate talked about in the uncovered parity relationship, the same interest rate differentials getting in boiled down into the forward rate discounts of the premiums being covered as a part of the covered interest rate arbitrage, the inflation differentials getting reflected with respect to the interest rate differentials being talked about as a part of the inflation, the international Fisher equation, and inflation differentials going down as a part of the change in the expected spot rates. That is what is being highlighted as a part of our relative purchasing power parity, and that is how we can look at the synchronization between the various international parity relationships. Right now, let's move on to our next aspect, where we are talking about all these various concepts which can be used to forecast the future spot exchange rate. We have already talked about the mechanisms of getting into the forecasting of the future spot exchange rate, which is nothing but the expectation of ST. So we could very well use the ex ante purchasing power parity method or uncovered interest rate parity method, because that is also used to give us the expected spot rate itself, right? Or probably we can depend on forward rate kind of a mechanism itself. Whereas when we have whatever we talked about, the uncovered interest rate parities and all, probably they are not bound by arbitrage and may not be suitable for short term and the medium term, and because of that reason, probably forecasting of the spot exchange rate may be an issue, especially using the uncovered. Whereas on the other side, the covered interest rate parity, which is using the forward rate kind of a mechanism, probably it is a decent one, but still it's not a good expector. It's not an unbiased predictor of the future spot rate, especially in the short to medium kind of a time frame. So because the purchasing power parity relationship generally holds true for longer time periods, probably for long term this is fine, but not for short to medium term kind of an approach. So that's the reason we talk about something called real exchange rate. Real exchange rate, especially between a pair of currencies, we are talking about whatever is the future spot rate. I am trying to adjust it with the consumer price index or some kind of an inflation index for the currency B divided by the currency A. This is a kind of an adjustment to the spot rate, which is expressed as the A per B kind of a mechanism. So whenever the relative purchasing power parity is holding true, the real exchange rate would be a constant, typically called as it is in the equilibrium. Now, when I am looking at the other side, when I am going for the long run, we are primarily depending on relative purchasing power parity, right? We are depending on relative purchasing power parity, and because it relative purchasing power parity generally holds very much true in the long run. Or we are also talking about the IMF's perspective. We are talking about the IMF's perspective of macroeconomic balance approach. This primarily talks about how much the current exchange rate, whatever is the exchange rate between the two currencies, how much it has to adjust. The current exchange rate, how much it has to adjust so that it balances the current account imbalance that is existing. So how much the currency has to adjust so that the current account imbalance is expected current account imbalance is typically equalized. That is what is the macroeconomic balance approach, or we are looking at external sustainability approach, wherein we are talking about by what extent should the exchange rate change from the perspective of the country's external debt, whereas the macroeconomic balance is looking at the current account balance or the current account stability. This is looking at the country's external debt as a ratio of the GDP. But to what extent a sustainability can be approached within this kind of a scope? Or we are talking about a reduced form econometric model, wherein we are primarily looking at from the equilibrium path of the exchange rate based on various macroeconomic kind of scenarios. Probably looking at the trade balance, net foreign assets and foreign liabilities, whatever is the relative productivity of the country. All these things are being considered to primarily come out with an equilibrium level, which is looked at probably using various mechanisms and models to typically assess the long run fair value. That is what is being looked at as a part of the assessing the long run fair value of the exchange rate. Then, now the important thing which can be looked at here is the carry trade, especially works when we are dealing with uncovered interest rate parity. We have talked about uncovered interest rate parity as the expected spot rate is equal to the current spot rate into 1 plus RA by 1 plus RB. So this is where what could happen is we have also talked about it in the short run to medium term. Probably this equation may not hold true, and the FX carry trade, the forex carry trade, is primarily meant to take an advantage of this kind of a situation. So probably here we are talking about the investor who is getting into an FX trade. He is more interested in investing in a high yield currency, the one which is giving more returns, and is borrowing in a low yield currency. So investing in a high yield currency because the returns are coming out to be much higher, borrowing in a low yield currency because the cost of borrowing goes much lesser. But what it says is, if that is the scenario, there should be a depreciation in the high yield currency. Of course, obviously, if the interest rate if RA minus RB is much higher, what we said is the currency A must depreciate with respect to currency B by that much amount. But that in reality, especially in the short term, it may not happen. So that's the reason, if the higher yield currency is not depreciating by the amount of the interest rate differential, then probably by getting into a borrowing scenario, heavy borrowing in low yield currency and heavy investing in high yield currency could typically result in generating a kind of a profit, and that is what we are calling as the carry trade kind of a mechanism. So typically we call this kind of a currency as the funding currency, and this is what we call as the investing currency, and it can very well be planned out to typically generate some kind of a significant profit. And especially when we are talking about on the other side. So typically when I have to compute the profit, I am looking at by what extent the interest rates have changed. Is it completely reflected in the change in the spot rate? If it is not expected spot rate, if it is not reflected, then there is a possibility of making a profit on one side. But on the other side, this is because this can exist only if in case of uncovered interest rate parity, and the uncovered interest rate parity does not hold true in the short run. Only in that kind of a situation it generally leads to a profit. Or sometimes if it is the other way, if the difference, if this number is negative, then probably it can even result into a kind of a loss. So there is a possibility, especially because of the return distribution for this. The return distribution, it is said that it is heavily skewed. It's not normal. Negatively skewed means there is a huge, there is a good chance of big losses occurring, and that kind of a loss is what we are calling as the crash risk. That's one major aspect with respect to the FX carry trade. Then looking at the balance of payments accounts versus the currency exchange rate, probably looking at the various elements of current account and the capital account, we can talk of the balance of payments. As we know that the balance of payments typically include the current account, the capital account, and the financial account. And we also know on one side that whatever the current account plus the financial account plus official reserves, they all should sum up to zero. So we have also talked earlier that current account talks about the exchange of goods, exchange of services, investment returns. All these things go as a part of the current account. So if we are talking about, the major thing that can be dealt with the current account is whether the sales, or exports are much more compared to imports. So sales are exports are more than the imports. We are talking about the surplus, otherwise the deficit. Then we are talking about, when we talk about the financial account, we are talking about in terms of debt and equity investments in within coming to the country versus going out of the country. And of course, when we talk about the reserves, we talk about the reserves that are held by the country. Generally, we don't see the reserves changing from year over year, right? So the major two things are the influence on the current account, and probably the financial account, or typically the capital account. So when we are talking about the current account, there are so many influences that can come on the current account relating to the cash flows that are coming through our exports and the imports process. The higher the deficit, we know this kind of a relationship. The higher the deficit means exports lesser than the imports. If it is higher, so supply of that particular currency is the supply is going to be much higher in that particular currency compared to the demand, and so this could release this could result in the current that particular currency getting depreciated or decreased in the value. So that's how the exchange rate can get influenced. Similarly, the composition of the portfolios, the debt sustainability mechanism, all these things could have a very significant impact on the balance of payments of the country, which will in turn have a major impact on the exchange rate also. So in general, if I have to look at any kind of an inflow, the higher the inflow compared to the outflow, that could increase the exchange rate. The reverse could very well decrease the exchange rate or result in a depreciation of the currency. So more and more inflows through whatever is the mechanism, especially with respect to the emerging markets. There is a downside also with respect to this emerging markets. More and more capital coming into this emerging markets can create heavy real appreciation of the domestic currency, could result in market bubbles and real estate bubbles getting generated, or it could increase the external debt by the government. All these kinds of problems could very well be created by emerging market currencies, especially if there are a lot of excessive cash inflows that can get generated. So even from that perspective also, the countries need to take utmost care in terms of balancing out between the kind of cash inflows that are typically coming in, because there is a huge influence of the balance of payments on the exchange rates of the currencies. Then, so when I look at the exchange rates, the various mechanisms that are being used to determine the exchange rates, straightforward, there is a Mundell-Fleming model which says both monetary policy as well as a fiscal policy, they play an important role on the interest rates, which means the interest, we have already seen interest rates play an important role on the exchange rate. So the Mundell-Fleming model simply says that both the interest rate, the monetary policy as well as the fiscal policy, both of them, they influence the interest rates and thus the exchange rate. So on the other side, when I look at the monetary models, they assume that the interest rate is fixed. So they assume that the output is fixed, which means the fiscal policy does not play any major role in terms of the influence on the interest rate. So they primarily believe that, or they primarily model that the monetary policies are the things which have primary effect on the inflation and thus the exchange rate. Whereas when we look at the portfolio balance model, which is primarily looked at from the market's perspective, the asset market perspective, this is primarily looking at the sustained fiscal policy deficits and surplus, to what extent it can very well influence the exchange rate itself. So what we could see is these three kinds of policies are looking at from three different dimensions. One is looking only at the monetary policy, one only at the fiscal policy, and one focusing both on the monetary as well as the fiscal policy, having some kind of an influence on the exchange rates. Now, if I have to look at the direction of the exchange rate, we could look at a pure monetary approach, which is primarily focusing from the concept of purchasing power parity holding true at any point in time. Whereas on the other side, this is an important approach which talks about Dornbusch overshooting model, which says if a monetary policy is more restrictive, this can result in appreciation of a domestic currency. So when we talk about monetary policy being more restrictive, money supply is being reduced, right? The money supply is being reduced. So this kind of a mechanism, it says that it can lead to an appreciation of the domestic currency in the short term. And so once the domestic currency appreciates in the short term, slowly depreciates towards the long-term PPP value. Whereas if in case of an expansionary monetary policy, it says that the domestic currency depreciates and slowly it again comes back to the long-term PPP value. So this is what is the approach the pure monetary approach is talking about. Whereas when these two are typically combined, I could clearly make out that in the short term, any expansionary policy in a short term, in the short term we could see that the domestic currency appreciation happens, whereas the contractionary policy, the depreciation is going to happen. Whereas in the long term, any expansionary policy will lead to depreciation of the currency, and the contractionary policy could lead to the appreciation of the currency. So that is one thing which we could see from here. So just as a quick summarization, when I am looking at both monetary policy as an expansionary and fiscal policy also as an expansionary, and there is a high capital mobility, we could see that the exchange rate can either go up or go down. There could be an appreciation or depreciation. But in case of both of them are expansionary, and I see that the capital mobility is not there, it will definitely result in a depreciation of the currency. So probably we could probably look at these four different combinations of the approaches. In what cases the exchange rate can appreciate, especially if the capital mobility is high versus the capital mobility is low. This kind of a grid can be remembered typically from a decent understanding perspective. Then we are also looking at the policy rate of the central bank, the mechanism, because we typically see that the central banks typically come into the various interventions and the controls which they typically put, and we see that the major intention of any control that is being brought in the central bank, especially with respect to foreign markets, is to reduce this excessive capital inflows, especially into the emerging markets, as I said earlier, could lead very heavily into the speculative bubbles. So, so the intention is make sure that the domestic currency does not appreciate that aggressively. And the major thing is reduce excessive inflow of the foreign capital into the country, because this can lead to very huge speculative bubbles, and it can lead to lot of crashes in the typical country. So wherever there is a possibility of independent monetary policies without hindering the currency value, it goes ahead for the implementation of the same. So the main intention is to bring out the effectiveness in this particular process, and what we could see is any kind of success with respect to the intervention depends on the size of the reserves with the central bank. So what we could see is, depending on the size and the average trading volume in the country. For example, when I talk about the developed countries, whatever the resources the central bank has, they as a proportion of the overall trading volume, they are very minor, which means whatever is the intervention or the capital controls which are being brought out by the central bank, they may not be that effective at the managing the exchange rate. Whereas in case of emerging countries, where that forms a very significant proportion, the size of the reserves, whatever the country has with relative to the trading volume, because the trading volumes will be much smaller with respect to those emerging markets. Wherever it is perceived that the trading volumes are much lesser, what we could see is coming out with this kind of interventions and capital controls, it can bring a lot of effectiveness into the market. So that's the thing. And probably the simple way they calculate their policy rate goes as per the Taylor rule, where we are talking about the risk-free rate, neutral real policy rate, plus inflation, which is bringing out to me my nominal rate. And this is where the inflation gap versus the output gap. Output gap is coming purely from a fiscal policy perspective. So there is an expected or targeted kind of an output minus whatever is the potential level of an output. Similarly, inflation gap, current inflation rate minus the targeted inflation rate. So this is what is typically going as a kind of an input to the central banks in deciding their policy rate, goes as per the Taylor's rule itself. And whenever we are talking about a currency crisis, the major thing we are looking at is a kind of a deterioration in the terms of trade. Foreign exchange reserves go down drastically in that particular country. The terms of trade in the country go down drastically. Real exchange rate is much higher than the mean reverting level. Generally, we say that the the exchange rates follow kind of a mean reverting kind of a process, but we see that the real, especially the real exchange rates, the real exchange rates go much higher than their mean reverting levels. Inflation rates is significantly higher. The equity market goes into very huge peaks and very huge troughs. Money supply relative to the bank reserves is significantly higher. All these things need to be considered from the perspective of an emerging currency crisis in the future. And finally, when I'm looking at using the technical analysis for forecasting the exchange rates, we know that the technical analysis can really give us a measure of the trend, which can be used by various forex dealers or for booking their profits, or probably for getting into various currency option markets and various such kind of scenarios. But what is typically observed is this trend following, especially with respect to the foreign currencies. The profiting from that is not really significantly observed post 1995. But what is typically looked at still is the main reason why people still go ahead using the technical analysis is primarily from a risk management perspective with respect to the foreign exchange carry trades, which we have discussed earlier. So this is what is something which I would like to cover as a part of this currency exchange rates determination and forecasting session. If you have any further queries, you can get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.